Hey traders, I wanted to start this video out hoping that it finds you all in an up week, an up day, and if not, to remind you that sometimes you have to take a step back, take a walk. The time you spend away from the charts, focusing on your emotional health, is just as important, if not more, than the time you spend in front of the charts. So, no matter what kind of day you're having, good or bad, remember to get in exercise and clear your head for the next trading day. For the video at hand, I wanted to talk about diagonal spreads a little bit more depth with a use case example. Big thanks to Josh for giving me this example to talk about. Hopefully this helps you all hedge your options, your long options, as well as increase your profits over the long run. Enjoy.
So what really struck me about the options here when I was looking to try to make this into a diagonal, you can still see my screen, right?
Mm-hmm.
So right now that 170 is at about 1800, so you're up a good bit. You're up what, about 320, or
Right.
now the spread's coming. Okay, so you're up about $300. So if we look at the Octobers, which is 32 days to expiration, like if we were to just go out 10 points above your 170 to 180, we could actually sell this 180 against it for about $540. And what that would do is that would turn into a diagonal. And so let me put this into my risk analysis. All right, so you bought it for 1480. You sold it for 5.55. Let's just say it's 540. So what the risk graph now looks like is this. You'll keep going up, getting profit until you hit the inflection point of 180 where you sold it. You're basically adding a cap to your profits. But that cap only exists as long as this option is on till October the 16th. Okay, you follow me?
Yep.
So if we look at it this way on the chart, let me clean up a little bit. So that's going to be our in the money, and then let's see by when. October 16th. So it stands to reason that we could get up to this level by, this date. We got a lot of time to get there, don't we?
Yep.
So ideally, we don't want that to happen. We don't want it to get in the money because we're going to miss out on the unlimited rewards of being long the option. So we may want to go a little bit higher. Okay, so basically what would happen is if we got up to here, with you buying it at 1480 and selling this against it, this basically makes your cost like about $900 on the option. So your risk is 900. And then if it got up to 180 and went past it, then now you're going to basically have a profit and loss of about $1,300. Because if you look in the bottom left right here, that's the 1017 expiration, right?
Yep.
So if we go forward, and we get to, let's just put it in here, 180 as our top value. Let's do this 200. Let's do this 190, just possible scenarios. So if we get up to this value by the expiration, which is going to be 1017, if we get to 180, we made $1,300, and that's where we had to close it because this thing's in the money. We got to close them both out. You still made pretty good money, especially if you consider that your risk was 900 because we bought it down. And notice how if it keeps going up, if it goes up to all the way to 220, we don't lose money. We get less profit, but we never lose money because there's two things that have happened. One, we've waited for us to get a little bit of profit in this 170 call. And two, because we sold something against it that was really much further out of the money, right?
Yep.
So there's a couple of different ways we could also do this. We could also say we want to go up to, let's look at the chart again. So if we see we've got these resistances here, these little wicks right here. So let's clear those. That would be about a good, nice clearance, 195. So that's another possible in the money. So let's see how that looks in terms of risk reward. Let that recalculate. We're only going to get 290 from that one because, it's further out of the money. So we're not going to get as much for it. But our max profit is going to be much, much more, $2,100, right? But our risk only got brought down to about $1,200. So it's still, risk 1,200 to make 2,100 in profit. Not quite a 2-to-1, but it's definitely better than a 1-to-1. Follow me there?
Yes, sir.
So what do you think? Tell me what your thoughts are, what you picked up on, what you missed.
So essentially, we're just doing this to offset costs and mitigate risk is what this is boiling down to.
Yes, yes, exactly that. It basically brings down your risk, and it caps a little bit of your profit if it goes in the money. But that's where the magic secret sauce comes in. Like, how far out do you want to do it? Because the closer to your long strike that you sell it, the more you bring down the risk, but the more you cap the profits. So ideally, in a perfect situation, this thing would just slowly creep up, but not enough to take that in the money. And then at that point, what you'll see is if you go over to the next day, then your risk graph turns into the unlimited because you got to capture all of this as profit. So if this goes up, 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 and let's say you go to 200, now you don't have that thing weighing you down, and so you can have unlimited profit. So the ideal situation would be that, let's say, price, say we sold the 195 against it, or let's just be aggressive. Let's say perfect scenario, it stayed below 180, but it went up. And let's say just before expiration, it got to here. It got to, basically 175. And then, bloop, that one expires. We get to keep our whole $500 that we sold against it. And then on the next day, which would be basically, I say 10/19, we can go to look to sell the November against it because we still have December, right?
Yep.
And so at that point, we could sell another option in November and capture even more of that buy down of the risk. Does that make sense? So you can be very dynamic. You can do it over multiple times.
Okay, so on the when you're doing the diagonal, are you having to do a buy and sell both to complete the diagonal, or since I've already bought the call on the December 170, all I'm doing is doing the selling portion to complete the second side of the task?
So, good question. There's two ways that you can do a diagonal. You can do a diagonal when you put it on, which is where the same time that you buy your long call, you go out to another month and further out of the money, and you sell one against it right then. And that's how you can do it in your platform to buy diagonal right then. Now, that has advantages and disadvantages. The disadvantages, if you don't do it right, you can still lose money on it, just like you could the normal way. But it does bring down your risk because you're basically buying it for the full cost of the long option, and then you're offsetting that cost by selling something further out. So you're still taking a cheaper trade.
Okay.
What I like to do is I like to wait to see some profit on that long option and then sell against it, because then basically what you're doing by creating a diagonal is you are locking in profits, because if you only buy one option, you can't sell half the option, right?
Yep.
So a lot of people get into something where they've made a little bit of profit on one of these big value options, and they want to lock in some of that profit because maybe it's at a resistance or maybe something's changed, whatever. This lets you be a lot more dynamic and do what you want to do, which is lock in some of those profits and offset some of that risk without having to close out the whole option. So that's the advantage of it. But you can start it as a diagonal, like especially, and you may want to, because that's 1480 is a pretty big option, and being able to offset that by another couple $100 by selling something further out of the money is very good.
So now you're talking about on your sell part of the diagonal.
Mm-hmm.
If you get to your cap that you've covered yourself with, on the sell portion, and it looks to continue trading in the direction that you want. Can you buy back the second half of the diagonal and just allow the option to run at that point in time until you decide to close it, or do you recommend putting in another diagonal further on out?
So what's going to happen if it goes all? That's a good question. If it goes all the way up to your max profit, like let's say the 195, if you go to try to sell, excuse me, I should say, if you go to try to close this option, it's going to be at a big loss because it's going against you. Because this sold option is going negative while your long option is going positive. At that point, you're basically just going to eat a loss, but you have the profit on the long option offsetting it.
To cover, yes.
To cover it. If you do that, you run the risk that the next day the stock drops and now you've given up some of your profits and you don't have that hedge on. So if you get to your max profit, I think you just have to take it, and you have to take both of them off at the same time. And that's going to be the smart way, because then you've kind of broken the hedge relationship and you've eaten the loss on the sold option by closing it, but you're not guaranteed that that stock's going to keep going up. So now you've put back on the full risk. Does that make sense?
Yep.
Yeah. So I would just, if it gets up to your max profit, you're making money anyway. Take it as a gift and go ahead and close out the whole thing. You're just you're hoping for that best case scenario where it just creeps up, but not enough to take your short strike in the money.
So what do you get into if it does get a quick spike?
Well, it just depends on how quick and where that spike is in relation to, in this case, the October expiration. Like if this October expiration is on the 16th and you get a spike on the 13th, that's that week, but you may have a chance for it to go, not in the money. Now, if it is this week, remember you're short an option, so you could get assigned. There's that risk as well. Because if you're short an option, the person that is long the option has the option to assign themselves the shares. In that case, you would have to go ahead and assign your option to cover that.
Gotcha.
And yeah, so that's the risk you run there, but it's easily fixed by just assigning your option. And then, as far as your account goes, you're still up in profit because you have that option which was worth more than the cost of them assigning you the shares or the short shares if they assign their option. Basically, if that happens, you get assigned 100 shares of Boeing short, and you just have to right-click in your platform, if that's how it works, assign yourself the shares to offset it. Probably, I think the exchange would do that for you, depending on how much capital you have in your account, because if you don't have enough to take it on, I don't know if it's going to be automatic or not. Depends on the exchange.
Okay.
But that's how I would handle it. I think, Joe, is just a basic ground rule is use it to lock in profits. In other words, let there be some profit in it first. And try to get it far enough out where you don't think it's going to get there, but give yourself enough to offset the cost.
Looking at your chart right now, if today it caps, so call it earlier on halfway up, if it caps, somewhere in that vicinity. If time continues on and it still remains above, will the value still rise to the peak even though it was capped? It's just following the cap further out on the time chart. You get what I'm saying?
Right. So, that's why this blue line represents the value of it, because at expiration. Because the further it goes in the money, you slowly start to get diminishing returns because that short option is working against you. But it's marginal compared to the increase.
Okay.
And so, if this thing spikes up to 200 while you've got this on with the 195, your theoretical value, let's just look at it. Say 200, and it did it today. You have this on, this trade, 1480, 291 sold against it. Let's just say it got 200. I'm going to adjust the dates here. So tomorrow, if it does that, you made 1,200. So let's see what happens as we go forward. You actually, as you get closer to expiration, even though it's far in the money, you actually start to make money. Because you notice this purple line right here? That's the theoretical based on the date. And it slowly starts to creep up to that level until it finally, at expiration, lines up with it. So you're still doing pretty well. You're still doing pretty well. So you may, even if it spikes up and you have this on, you may just want to wait until, the week of a few days before expiration to close it out at whatever it's at, because you'll just make more as time goes along.
That makes sense.
Yeah, that's a good question about it. Trying to think of some other examples of what might happen to you. If it goes against you, well, then you're pretty much just going to get the full value of the sold option, but then your long option is going against you, and that just sucks, but, at least you had that sold against it, which brought down your risk.
So essentially you'd be losing $1,000 instead of $1,500 on a $500 sale.
Right. Uh-huh. If you did the one, let's just say the 185, which was 400. Yeah, now we're coming to a nice 1,000 that you did. So that's a good even number of the 185. That gives you 15 points of play between now and October. Max profit would be about 1,500 for 1,000, 1.5 to 1. It's not bad. I'd want more, but maybe in your best case, it doesn't quite get to 185 by October, and then you can sell in November against it and get that down even lower.
10-4.
Yeah. And to go back, I figured out what I was doing wrong. So if you're going to put it on, I know what I was doing wrong here. So let's go to your original December 170. So if I was going to put this on today, buy diagonal. So yeah, no, I wanted to buy the 18. So yeah, it's kind of wonky. Let me fix that. So buy the December 170, and now we need to go further back in time to October and sell the 185. Boom. That's what it would cost me now to put this on. So instead of paying $1,800, today this would cost me $1,350. So about a $500 reduction, and that would basically give me what I had here. Now you got it a little bit earlier, so you're in much better shape, and that's why I prefer to put these on and then capture some profits. But at the same time, people can use this to buy down the risk of a trade to begin with if they think that they're really good at picking price and time. Any last questions?
I don't think so. I think you've got it explained pretty well.
All right, cool, man. Glad I got through to you.
Right on.
So,